Hi folks, and welcome back to Meaningful Money. I'm here in Mousel, the sort of archetypal Cornish fishing village. You can't actually quite see it. I'll try and get round into the harbour a little bit later, but I think it's some kind of festival week or something. There's tons of people around, so this is definitely the most public video of these I've done so far. Still talking about wrappers, and today's subject is investment bonds. Now the problem with the word bond is it means about 6 different things. We've talked about corporate bonds, we've talked about deposit bonds, which are sort of fixed term savings accounts, but this is what we call investment bonds or insurance bonds. Now what they are is a wrapper, just like an OIC that we've talked about or an ISA. But an investment bond is a different kind of wrapper, different set of tax rules, but essentially it's a single premium life assurance contract. But that really is only talking about the tax treatment of it. Essentially it's just a wrapper you put funds in, a little bit like an ISA, although slightly more limited in what you can put inside it. So it's a wrapper. Now let's talk about the tax treatment, the thing which distinguishes a life assurance bond. Firstly, you hold a fund usually within a bond, and the investments within that fund, if they produce an income, that is taxed at 20%, but not on you the investor, but on the fund itself, 20%. There is no capital gains tax within those funds or anything like that, so as long as your money stays in the bond, as long as you don't encash it, the tax treatment is effectively at 20%. So if you're a basic rate taxpayer, which is the 20% band, then you're no better or worse off having an investment bond. If you're a non-taxpayer, you shouldn't have an investment bond because you are worse off for tax, generally speaking. One of the best things about investment bonds is there is a facility there to draw a set amount every year, up to 5% of your original investment. And if you do that, there's no tax to pay on those withdrawals, so they're not income as such. It's a little bit like you going to your cash machine once a month and drawing your own money out. But there's no tax to pay on those investments. They are tax deferred. There can be tax to pay when you subsequently surrender, but I'll come back to that in a minute. But that 5% withdrawal is really useful, particularly for, you know, if income is important to you. It feels like an income because you can draw it regularly, maybe monthly or quarterly, something like that. But it's not income in the tax sense. Although, as I've just said, tax within the thing is about 20%. But on encashment, well, the tax then to you the investor, so when you take your money out of the investment bond and you encash, the tax on you the investor depends on your personal tax status. So if you are a basic rate taxpayer, that will be different than if you're a higher rate taxpayer. I'm not going to go into examples now, I'll leave that for another video. It also depends on whether you've made withdrawals throughout the term, and it depends on whether the bond is held in single or joint life. But the tax for you the investor, you might as well forget about that until you encash the bond. So why would you have one? Well, they're useful for trusts because technically speaking they don't produce an income at all. Income tax on trusts is punitive, so holding investments in bond can be useful. If you're an individual investor, you must be careful when thinking about taking an investment bond out. They should be compared very carefully with things like OICs, because with an investment bond there is never any capital gains tax to pay. But everybody gets a capital gains tax allowance, and if you invest in OICs you can use that. If you invest in investment bonds you can't. So when thinking about taking an investment bond out, you must compare it carefully with an OIC or something similar like that. There is an added benefit of investment bonds which is little known. Because an investment bond is a life assurance contract, if you are being means tested for long-term care, sorry about the seagull, if you're being means tested for long-term care, it's a little known fact that if you've got your money in investment bonds, those cannot be counted for the means test. Now that said, that doesn't mean you can stick all your money in investment bonds and have a little accompaniment. That doesn't mean you can put all your money in investment bonds and get away without paying any care fees. The rules say that you can't give money away or deliberately deprive yourself of assets. So if you dumped all your money in an investment bond just before needing long-term care, that would certainly be unwound. But if you have long-standing investment bonds, they can be discounted for means testing. Now the last thing to say is that there is both onshore bonds and offshore bonds. So onshore bonds are offered by life assurance companies based in the UK. Offshore bonds are offered by life assurance companies based outside the UK, usually the Isle of Man, Guernsey, Jersey, Dublin, places like that. And the reason for that is tax again. Everything that I've already said applies, except that, remember I said that in an investment bond, the investments within it are taxed internally at 20%. Well, that's not true in an offshore bond. So that's pretty good, because instead of paying tax as you go along, the money can grow, hopefully, tax-free. But what it does mean is that when you come to encash it and bring the money back onshore, take your money out, then you will pay tax in full at your sort of normal rate. So if you're a basic taxpayer, you will pay 20% instead of paying the 20% as you go along. So the offshore and onshore, that's basically it for investment bonds. So next time I'm going to talk about investment trusts, very similar to OICs that we dealt with time before last, but with some important differences. And then after that we're going to move on to pensions. So from Mausel, thanks very much for watching. See you next time.